Hey, what is happening, Bulls and Bears? We're back with another dose of you know what, and we've got to talk about the big bet and the big short bet that a major investor, we're talking about a billionaire, someone that's definitely in the top 10%. This particular billionaire has a very big short bet on the stock market. And two indexes we're going to talk about here. Folks, this is Michael Burry. I know this was in the news a few days ago, but I didn't realize how big it was. I read the headline, but I didn't realize how big of a bet it was. Now, initially, another reason why I blew it off is because I didn't know the amount of the bet. I didn't read into the article, my fault. But I also didn't know how significant and how big of a portion of this investor's portfolio this person is putting on the line. And we're talking about Michael Burry. Now, if the name sounds familiar, if you watch the movie The Big Short, that's basically the character was based on one of the characters based on this particular investor. And he shorted subprime real estate or subprime loans in the housing market back before the housing bubble went bust. So ever since then, people have kept a very close eye on this person, to say the least. And we always talk here about how most stocks, close to 90% of stocks, are owned by the top 10%. And I know many of you here that I've read down in comments, you follow what these big money billionaire investors are doing. So this really shouldn't be any different. Even if you're not an investor, you should really take a look at what people like this are doing to kind of prepare yourself, for what might be ahead of us, right? So let's take a look at the enormity of this bet here by this particular investor. Now, this information is public via SEC filings, and I've got a screenshot right here of his positions. So he is shorting meaning he's betting on the market's going down, the price is falling. He's shorting indexes, S&P 500 and the NASDAQ 100 via put options on these particular ETFs that track those indexes. So he's going short, and it's a big amount. We've got $886 million right here and $738 million here, total of about over $1.6 billion. Now, with put options, just like all other options, there's an expiration date. So the question is, how far out is he betting? Is he looking at a 2-year put option? Is he looking at 1 year? Is he looking at something more soon, like 6 months? Well, we're going to get into that. But first of all, this was pretty alarming to me, pretty eye-opening anyways. This is 90% of his portfolio, folks. 90% of his cash position is in these bets. Now, I shouldn't say that's all of his cash because he may have a lot of cash out of this particular portfolio. But if you look at it here, it's over 90% of this particular portfolio for whatever investment platform that he's using, right? Now, just to be clear, he could have 3 or 4 other different trading accounts. So this might only be a small part of his overall portfolio. But when you look at just this particular platform, it is a very big chunk here, over 90%. Now, many of you may recall that I try not to put dates or timelines on market crashes. Why? Because the markets are controlled by a small percentage of the population. We're talking about, again, the top 10% own about 90% of all stocks. But when you have someone in the top 10%, like Michael Burry, putting such a big bet out against the stock market, that should be pretty alarming indeed. So all the headwinds that we're seeing facing the economy, remember the U.S. economy is about 70% consumer spending. So when the consumer gets buried under debt and gets tapped out, that should be an indicator that we're approaching the end game. Now, we saw this in 2019 leading up to the situation in 2020. Of course, 2020, everything was reversed. Instead of a crash in the markets, we saw a brief crash in the stock market, but then we saw it surge to all-time highs again in just a matter of months. So instead of a crash back then, we had massive inflation and asset prices going up. So we could see one of these brief crashes, not quite a flash crash where the market drops and comes up the same day, but maybe a big drop and then the market recovers in a few weeks. Or will the money behind the market not be there this time? Will the market go down and stay down if this particular stock market crash comes to fruition, like Mr. Burry is betting on? Now, what I mentioned a few minutes ago, let's double check that. Is this 90% of just that particular platform or one of his trading accounts? Or is he betting 90% of his overall portfolio? Let's take a look here. The way that CNN is reporting this, it's actually 90% of his overall portfolio, because it doesn't say in this particular trading platform or this particular account, it says using more than 90% of his portfolio. So that reads to me like this could be 90% of his overall portfolio. And that's per the SEC filings. So if that is correct, that is some pretty serious betting against the stock market. So what does he know that maybe others don't know? Is something big in the cards that's going to bring this market down? We saw what brought the market down briefly in 2020. That was a global situation there with the health crisis. Is something worse on the horizon for someone so famous and for someone so wealthy to bet this much of their portfolio? So it's pretty serious and something to keep an eye on here. Now, there's a firm out there that tracks the trades of big investors like this, like Michael Burry, and his annualized returns in the last 3 years have been 56%. 56%. Think about that. So you park your money in a money market somewhere right now with the rates being a bit higher, you can get 5%, even close to 6% right now. He's making 56% annualized returns by betting and by investing in the market, right? So definitely not a passive investor by any means. He's putting his money where his mouth is, right? So I encourage everyone to think strongly about where your money is positioned right now. If it's in the stock market through your retirement account, you may want to look for something less risky, maybe a money market, maybe something more into bonds. Not that there's not risk in that, but the stock market, I mean, look at what's happening right now with the economy. Do you think the stock market should be where it's at right now, considering the position of the consumer? $1 trillion in credit card debt. We've never seen that before. This is more than double the credit card debt that we saw prior to the financial crisis of 2008. So something big is about to go down. Do I know the exact date? No, I don't. But I can feel it. And obviously, other people, billionaires, are feeling it. And maybe they know, not just feeling it, they know what's happening. Maybe they've got the inside scoop on this. And to give us a gauge on the economy, let's take a look at some stats right here. Americans earning at least $125,000 are being laid off at 3 times the rate of low or moderate income earners. All right, so this goes beyond just cost cutting, beyond getting rid of some staff to cut costs and to reduce their overall expenses. This is big, and also $1.4 trillion was lost by the top 500 richest people on the planet. Now, they're in the top 500 richest people. They'll be just fine. I'm not putting this out there to feel sorry for them, because they'll still have a lot of money because they're in the top 500 income earners. But the fact that they collectively lost $1.4 trillion, I mean, that's a pretty big number. Also, the number of millionaires is plunging, and we haven't really seen a big correction in real estate yet. Just wait until we see a much bigger correction in the housing market. But even without that big correction, the number of American adults whose assets totaled $1 million fell 1.8 million at the end of 2022. So it's 22.7 millionaires now. It used to be over 24 million millionaires. Let me make sure I get that right. There used to be over 24 million millionaires. Now it's 1.8 million less. Also, speaking of a housing market slowdown, take a look at this out of Bloomberg. Mortgage rates climbed to 7.16%, the highest level since 2001, folks. We're talking about a 22-year high in this. Home prices up until now have held up very, very strongly. But when it rains, it pours. When the market starts taking a big turn south, I think we're going to see price corrections probably more severe and more fierce than we saw back in the previous housing bubble going bust. And I know that seems hard to believe because prices have been so sticky. But remember, when markets turn, they tend to turn very quickly. And now with all this leverage here, all this debt, the consumer barely skating on the financial edge, I think this could be a pretty big plunge. And I just wanted to minimize myself here so you could see on the edge here on the right that how big this is compared to going all the way back to 2001. But also, when we talk about price corrections, market crashes, housing market corrections, falling prices, deflation, we have to talk about the dollar. The dollar getting devalued and collapsing could also be an inflationary force and even possibly bring on hyperinflation depending on how fast it hits. Here's the US dollar index, and this is compared to other currencies throughout the world, which all other currencies right now are fiat currencies, just like the US dollar, meaning they can be created at the click of a mouse to infinity. But here it is. We're only down 2.8% year over year right now this year compared to other currencies. We're talking about the US dollar. But how much worse will it get if we have this announcement out of the BRICS countries that there's going to be gold more heavily integrated into their trading system? And that announcement later this month, actually coming up in about a week here, is going to be one of the big things we're going to be keeping an eye on here on this channel. And we're going to analyze that and try to decipher, what exactly that means. But we'll also keep an eye on the dollar index. But most importantly, just take a look around you, the cost of living. Are you seeing anything improve? I'm not really seeing it. We're a year out now from that Inflation Reduction Act. And myself and people around me that I talk to, that I communicate with, including people at work, customers at work, are not feeling better about inflation. In fact, the cost of living hasn't really come down overall for anyone that I know that I talk to, including myself and family that I talk to. It's actually staying the same or getting worse in some areas. There's a couple spots where prices are coming down. Gasoline, we're up about $5 a gallon here in California. Insurance costs are outrageous. Energy power costs are outrageous. The cost of insurance, outrageous, going higher for most people anyways. Let me know if you're seeing any price relief in anything that you have to buy, to make a living here. But I'm not seeing much of a correction at all. So the Inflation Reduction Act, what the argument is they'll say, yes, it's a success because without that, prices would have went up even more. Of course, they're always going to make that argument. They're not going to just say, oh, we failed, it was wrong, it was a bad policy. They're never going to say that, of course. They're going to say, yes, it would have been much worse without it, right? So let's say you were working security at a warehouse, and all you had to do was stand out in front of the warehouse to deter thieves. You're standing out there with your uniform on. Nobody's going to break into the warehouse, and you work that job for 6 months, and the warehouse gets broken into 3 times in 6 months. So then you get called into your boss's office, and they say, we're going to have to let you go. You were supposed to keep this warehouse safe, and it got broken into 3 times in 6 months. So your argument would be, well, yeah, it got broken into 3 times in 6 months, but it would have got broken into 10 times if I wasn't there because I stopped another 7 attempts at the break-in, right? So you can always say it could be worse, and I think that's what they're really putting out there, with this Inflation Reduction Act. They're going to say, well, yeah, it would have been a lot worse without it. The cost of living didn't come down, but inflation went up slower than it would have if we wouldn't have passed that act or if we wouldn't have passed that bill. You see what I'm saying here? So they're never going to be able to get pinned into a corner, so to speak, on the failure of these types of spending programs. And that's what I find really frustrating. No matter how bad something ends up being or what kind of bad effects it has, they're always just going to come out there, yeah, but it would have been worse without it. This still helped people. So it's really tough to convince people on what's going on here because they hear these people talking and saying how they saved the people. We put this bill out there, we saved millions of people. Prices would have exploded without this, right? So there's always that unknown or unseen that we're always going to have to deal with here. Speaking of financial hardship, almost half of all student borrowers expect to go delinquent when payments resume. We talked a few reports ago about how over half of these borrowers had said they had to choose between making their payment or buying food or keeping the lights on, basically. And now here's another study here. This one's out of Money. Almost half of these student loan borrowers expect to go delinquent. So not far off from the one that said 56% of students are going to have some big, big problems here. And that's coming up here just in a couple months. So is that what Michael Burry is looking at? And, is that one of the things that he's looking at? Who knows what his strategy is? Maybe he's got a whole bunch of different criteria that he looks at, or different data that he looks at to make this determination to place such a big bet against the stock market. Also, speaking of danger ahead, the central banks out there, and they're changing their tune on inflation. Before, first we heard that it was transitory, that it was no big deal, it's going to go away. Then we heard that it's sticky. Remember that it's sticky. Now it's more than sticky. Now they're coming out and saying significant inflation risk may require more rate hikes, right? So they're no longer trying to cover this up. The truth is revealed, and it's going to be higher rates for longer, and maybe even more hikes here coming up. The next meeting, I believe it's going to be in September. And how much more pain is that going to add on top of the consumer that's in $1 trillion credit card debt right now? And maybe that's something else too that Michael Burry sees. He sees the tone, or he hears the tone coming out of these officials, these decision makers on these rates. And, he's just adding two and two together here. Also, another report here, officials fretted U.S. inflation might not cool unless economy slows down. In other words, what they're saying here is that people losing their jobs is deflationary, unless you go back to 2020, where people that lost their jobs ended up with more money because they had stimulus checks with enhanced unemployment benefits. Many people end up making more than they would have if they would have continued working. So that's why on this channel we urge for, and we hope for, a hands-off economy where prices will correct to what they correct to without intervention, without rescue programs. And that way, yes, it's painful at the beginning, but it's better in the end because the cost of living is not so out of reach for a majority of the population like it is now. Right now, we have people living on credit cards. Why do you think the debt's climbing so high? People that bought homes are hanging on for dear life. People are house poor with all the expenses that come along with owning a home, especially if you bought at the peak of this bubble. It doesn't mean they can't manipulate it higher, but a hands-off approach right now means prices would plunge. That means no rescue programs, no dropping of the interest rates. If that were to happen, you'd see these markets correct, including the housing market, by at least 50%. I'd have to say closer to 80 or 90% if you take away the fake money behind all this. Probably even worse than that, probably 95% or even higher. If you take away the fake money, that means banks can only loan out money they have, and the money needs to be real sound money, backed by something hard, tangible, something with a limit to it, not just the click of a mouse, but something like precious metals. And, we're headed in that direction. How much longer it's going to take, it's anyone's guess. Please let me know your timeline down below as far as, one, going back to sound money. What do you see coming out of this BRICS announcement here? And two, Michael Burry's put on the stock market. It's a pretty big put, betting against the stock market, meaning he's waiting for a crash coming up in the very near future. Now, one more thing before I get out of here today. I wasn't able to find the expiration date on those put options that were bet on by Michael Burry. I even went to this article right here. Now, there's an article out there out of Market Rebellion that says, no, he didn't bet 93% of his portfolio because the values could change as far as that, and possibly he has other accounts, right? So anyways, take that with a grain of salt, but it's still a pretty big bet regardless. Hope everybody liked this report. Please like, subscribe if you like what we talk about here to help this channel stay alive. And we'll see everybody on the next report right back here probably tomorrow. So everybody keep stacking. Bye for now, Bulls and Bears. Peace.